Good morning. Welcome to a Mindset Meets Mechanics. We're going to look at some portfolio considerations using real money portfolios that are managed using SPA3 Investor. So it's an update. Last time we did one of these was a month ago. We're going to look at some portfolio stumbles and leaps. And I'll just go over one thing that I did cover a month ago, and just because that has now been implemented, which is a rules change in the ASX public portfolio, and I'll cover that when I get to it, and then we can have a Q&A afterwards. And because we are dealing with real live data, everything we cover here today is general investment advice. There's no specific or personal investment advice that we provide, and we're not licensed to. A reminder of what our trading objectives are with, not the public portfolios, but with us as investors, because the portfolios I'm going to show you here today are a portion of my own real money, my own wealth, if you like, that I trade the portfolios with using SPA3 Investor. And I do have other personal portfolios outside of the public ones as well. So the idea here is to always have in mind risk number one and risk number two. So risk number one is absolute return. So keeping score of where we are and how we are doing relative to the environment, which provides the opportunity to grow our wealth. And always having in mind risk number two as well, which I want to avoid for all of my stock portfolios. And that is the sequence of returns risk. That is the order in which large drawdowns occur. Obviously, if they occur earlier in life, then it's not as much as big a problem, because you've got enough time for your wealth to recover from a large drawdown. And here, obviously, I'm thinking of 2001 to bear market, 82% fall in the NASDAQ 100, 56% fall in the S&P 500, and 2008, where it was there was a 54%, I think it was, a 49% drop in the S&P 500. So we want to avoid that, and particularly as we move through our lives, the older we become, the bigger this risk is, because there's less time for us to recover from that. So we want to remove the possibility of having a 50 to 80% drawdown in our portfolios, and that is in mind. And I'm going to show you a chart in a moment, because as we get older and as the markets move and change, and the cycle of our lives doesn't necessarily match the cycle of the markets, so we need to fit in with the markets, not the other way around, try and make the markets fit in with us. That is not what we are trying to do. So I have this as a motivation, as a recursive loop going on in my mind all the time. There's the reward side of things, the upside and returns, and there's the downside, if you like. And what comes to mind is buy and hold ETFs. That obviously there's a massive move worldwide going into that, and that's all great while the markets are rising. But when we have the inevitable 50 to 80% drawdowns in major indices around the world, not going to be such a good strategy. Right, let's just have a look at recent market conditions, looking at the S&P 500 first up. What I've got here, there's this sideways moving all the way down. I think that was a 37% fall there in 2022 on the S&P 500. Then we've had this run up, this rise from October 2022 in the S&P 500. So just a slight smidgen over 2 years. Great run up. But what I'm looking at here is the breakout to new highs, which occurred here, where I'm showing on the graph, on the chart now, but I'm measuring whether you measure it from there or from the breakout here to the high, the recent high that the S&P 500 achieved. That's a 25% breakout, if you like, run up from the previous all-time high over there. So this breakout from here up to here, 25%. And that's obviously been a good, decent market. We had a couple of retracements, one over there, another one over there, because, as you know, markets don't go up in straight lines. So it's been a pretty good market in the US from October 2022. Of course, people were not thinking that. Back here, there were all sorts of predictions happening in that third and fourth quarter, and even going into the beginning of 2023. And I put that up in the secular bull market update that I did a couple of months ago. Some really big name commentators were calling this as having reached that high back here in January of 2022. They were saying that was it. 10 years plus of sideways to down moving markets, i.e. a secular bear market is what they were predicting back then. And it is henny penny. The sky is going to fall on our head for some people who are getting on in their lives, maybe in the rest of their investing lives. But we don't listen to innuendo and commentary and opinion and hearsay. We got to look at what the market tells us. We listen to the market, not to people. And that is what we do with mechanical systems. We let the price action be the language to us. So the US market has broken out. It's doesn't look like 10 years of sideways. And by every way that you may define what these people who are saying, they have been proven wrong. By the market, not by people, but by the market. And of course, let's have a look at the all ordinaries. And I've got here a chart at the bottom, which is a relative strength comparison between the all ords and the S&P 500. Equivalent measurement, and whether you take it from where I've got the profit loss dotted line over here, but an 8.8%, 8.86% run up from that high or from the breakout over here. So just about a third of what the S&P 500 has done. So US market obviously much stronger, and you can see this relative strength line declining here. So it was rising during the fall, meaning that the all ordinaries, the Australian market, was not falling by as much as the S&P 500. But since the growth has taken place and the S&P 500 has started rising, and this goes from February 2023, so some 19 months, the S&P 500 has been outperforming the all ords, or the all ords has been underperforming. Flip that around, and obviously that's the blue line, the relative strength comparison showing that. So those are the conditions in which we've been running these portfolios, these real money portfolios. Right, let's just what I'm going to do now is look at three portfolios. There's an ASX Sparta Investor public portfolio, there's a US public portfolio, and there's a leveraged public portfolio. I'm keeping the leveraged in here. We'll be making some more noise about the leveraged portfolio and the changes in the research that we've been doing in that area of recent times. And over the next month or two, you're going to see a bit more about the leveraged portfolio. We're having more inquiries about it, and you'll see why in a moment. It's why that's pretty obvious to you that the objectives of these is to have real world warts and all portfolios. And with the leveraged portfolio, it's been a learning curve. There's no doubt about it, and it's generated research. That's what we do when we get results. We take theory into practice with real money as opposed to just looking at simulations, and then the real money experience, the events, the ongoing cumulative experience that comes from those events, as anybody would be just learning. You need to do that just to learn to trade properly. But obviously, to do research and to improve things, as Mark Douglas says, we're always in this mindset of development, which really says, what do we need to do to get better? And that's what we are doing with real money, with the leveraged portfolio. And it's got us to do some more research and make some more changes. And we're honing in on a pretty good solution in that area, but we'll make some more announcements. And that comes from the real world warts and all conditions that we've been trading that leveraged portfolio in. And it's not just about timing. It's not just about the edge in the system, the buying and the selling. It's about mindset, which is huge. And we've put a lot of emphasis on creating new training in that area over the last year, and in money management, position sizing, and particularly in a leveraged portfolio. So for the objectives of running these for your edification, for learning, for me to grow my wealth, and also for me to stay and the business to stay at the leading edge of continuing to refine and research. It's an ongoing iterative process that never ends. And we do that for you, and selfishly for ourselves and for me too. And we're all in this game together. But this is why I have these real money portfolios. And it's also about continuing to test my skills, to be mechanical, to be methodical, to be objective, and continue to trust and to accept all the risks, and to be confident in execution, and most of all to be consistent. And that is where the unflappable, peaceful way of trading comes around. But you need to be able to do that and test yourself under pressure in the real money, in the real world where you've got money at stake. So that's what this is all about for both yourselves and for myself. So let's quickly have a look at some sells over the last month. So this is just really an update. So we look at the ASX portfolio first. We've had 4 sells, all lost trades, and those are them there. Relatively short one was pretty quick, Blue Scope. The others, and this is these whole days, this whole period includes weekends, so it's absolute all days. You divide by 7 to get the number of weeks, not by 5 as you do with some trading software. Right. So the rather large one there was Treasury Wines. On the US portfolio, just 2 sells over the last month, 1 profit trade, 1 loss trade. And on the leverage portfolio, a few more sells here, and 2 of these were instigated because of position risk, which is a money management tool that we've put into the leverage portfolio, and they were 2 profit trades. So the 2 that were initiated by money management were Google and Apple, both profit trades, and there was 1 large one there. So from a stumble perspective, what I define as a stumble trade is a trade that's greater than 10% loss. And what we will find is there's been, over the life of these 3 portfolios, there's 30% loss I recall, which was Netflix, and there's been a couple of 15% losses as well. But once you get over 10%, that's, as far as Path-Through Investor goes, that's in the stumble territory, if you like. It's a bit bigger than the average. The average is somewhere between 7 and 8% over the life of the research and the real life trading. So those are stumbles that we've had in the last month. Right, we're going to have a look at performance now. We're up to 8.83 years of real world execution. We've made some mistakes, and I'll keep reminding ourselves of this because we've got to keep it front of mind so we don't make these mistakes again in the future. We ran 2 US portfolios and we made them mutually exclusive. If you are going to run more than 1 portfolio, the only difference you really should have is the number of open positions, but you should take you should have overlap in trades. So don't make them mutually exclusive. If you've got vacant positions and 1 trade comes up and you've got vacant positions in both portfolios, then take that single trade in both portfolios. They'll have different position sizes. So mutually exclusive, we found through real money trading that it affected the portfolio, the main portfolio, the one that we continue to track negatively. The other one was when you reduced position sizes from 13 to 10. That also has lost us some performance as well. On the ASX, I'm not calling this a mistake, and I'll talk a little bit about it in a moment, but I'm calling it an improvement. It's not a mistake because it was the money management, the execution, everything was done properly. And but with the benefit of some additional research, hindsight if you like, over 18 months of new out-of-sample data, we realized that it would have been better to have the stock filter on rather than off, right? Sorry, the other way around, to have it off rather than on. So we had it on from May 2023 last year to current, and we've now turned it off. And that's turned out to have put a handbrake on performance. So we'll show you that in a moment. So we make the adjustment. We do our research, we re-research, and we make the adjustment accordingly, and we live with the consequences. Right. So we're going to have a look at open trades and some periodical metrics now. I'm going to get into beyond charts, and we'll also look at some equity curves as well. So getting into beyond charts, we'll go straight to the ASX public portfolio. And what I'm starting with here, so these are all the metrics that we have. Of course, you can go into summary and see where you are. So the value of the portfolio is 218,000 at the moment at yesterday's close. And statistics, we over the last 12 months, so I've just got 12 months over here. The 19th of the 11th, 2023 must have been a weekend, so it goes back to that Friday. And we're running at 17.24% annualized growth, well, that's just 1 year, so annual growth compared to the All Ordinaries accumulation index, or it might be the ASX 200, sorry, being about 4 and 5.5 points ahead of the public portfolio. And there's no doubt that the stock filter, and I'll show you a chart in a moment, has played a role in that being like that. So let's now go back a year, and so make it 2 years. Over the last 2 years, it's been the ASX 200. It'll tell us over here is that is US. Okay, the ASX 200 accumulation index has outperformed the public portfolio, and if we go back, what do we do? I'm not going to do the whole lot. We go back to 2018. It's over the last 6 years. It's the public portfolio is better by about 3.5, and if we go to inception, it's better by about 2.34 over the life. That's annualized return over that period of time. So we know when we have a look at the equity curve that it's been going sideways for some time. Before we look at the equity curve, we'll just see what the open trades are at the moment. This is as at yesterday's close. We've got 9 open trades. 2 are in loss, and the other 7 are in profit. We'll just scroll by profit here, and you see we've got a 9,700, which is JB Hi-Fi. Let's actually do it by percent. The biggest is JB Hi-Fi, 43%. Aristocrat, which is relatively new, it's been 4 months in the going, 33%. And there the likes are over there. Real quickly, so what I typically do every now and then is I will get into the I'll get into it, and I have this set up all the time under a worksheet. So I've got the actual watch list of the portfolio, and you can find that in your watch list. So automatically when you buy and sell stocks, the watch list is automatically maintained for you in Beyond Charts, and I just keep that here in my in a workspace, and then I just quickly pop down through it so you can see where the exit signal was there. We've got a double dividend there, and it just gives you a schematic on where things are. Sometimes I'll put some analysis on. If you look at Aristocrat, for instance, has been in a nice big uptrend. We should also just point out over here how the juiciest of trades start not necessarily at the breakout, but down here at the bottom of ranges as well, and in mid-range, as this one did, and then breaks out. Okay, and then when you get a breakout and a signal occurring right to make a new all-time high, those are typically juicy trades, but there's been one in between over here. We didn't do this trade in the public portfolio because we were fully invested at that time and didn't have vacant capital. But you can see how the gradient of the trend here, I've made these dotted lines. That was the gradient beforehand. We've had this breakout, and now this trend is accelerating. Good trade to be in. Right, what else we got? Next is ResMed. Similar thing, ResMed approaching a new all-time high. Is this going to be like Aristocrat, where you have the signal started about mid-range? There's the sideways range, mid-range. Will it break out and accelerate like Aristocrat has? We'll wait and see. This is Breville Group. There's its all-time high over here as well. So you're seeing a lot of this where we've the stocks, obviously the All Ordinaries, as we showed you the recent movement since over the last 2.5 years, has been sideways to a small breakout. So we're seeing a lot of stocks approaching or at or just gone through new all-time highs. That's a good thing. This one hasn't yet. What is this? This is Rio. Hasn't got to a new all-time high, but the longer these ranges go on for 2.5, 3.5 years, the higher the likelihood that they're going to break out the top. Here's one that has broken out the top. Sorry, no, that isn't. This is Blue Scope Steel. Hasn't either. Also still in the range. It's in a loss. It's a small loss trade at the moment, and we need to see if this breakout is going to be the breakout, or whether it continues going sideways. We don't know. Computer share, there's a breakout, also long term. Just you can see the patterns there, which is why I'm going through this on this occasion, is that when you look at what's happening in the market, reaching new all-time highs typically means more highs and uptrends. Breakout and on a big rise. We'll look at some trades in the US. Look at this, a big jump from there to there. What I do sometimes with these is go and look at, just do this and see what the jump was. So that was quite a big jump. That was a 9.49% jump on to cause the signal, to create the signal. Now that has stock filter on. Obviously we've got to turn the stock filter off. No filters. Put it there, and you'll see that was the signal that we entered on. That's a signal day on a 9.94% jump. So that's the ASX. We'll quickly have a look at the equity curve and see what's happening. And this is one that I maintain. It has the black one is the All Ords, the red one is the ASX 200 accumulation index, and there's that sideways movement. Will we have a breakout? I've had breakout to new highs in my own personal portfolio, has fewer positions and larger position sizes, and hence has a different mix of stocks as well. So I know there are customers out there that are whose ASX portfolios have reached new all-time highs, but that is not what we want to see. We'll show you in a moment the effect that putting the stock filter off, turning it off, has had. Right, let's go to US. So this is the last 12 months, 2023 to 2024, and we look here at drawdown. Let's quickly look at drawdown. Maximum drawdown of the portfolio versus the index is about the same, 0.3% more in the portfolio, and we're running at a portfolio risk reward of 0.22. That is excellent. Anything less than 1 is good, but so is the index being excellent, 0.26. And the annualized or the annual growth over 1 year, 39.92%. So about 7.3% outperformance of the S&P 500. Let's go back to 2022 and look over the last 2 years. Over the last 2 years, also outperformance of the portfolio, outperforming the S&P 500, which, as you know, 93%. If you look at the at SPIVA report, 93% of managed funds, mutual funds, underperform the S&P 500 total return index over long periods of time, and even short for that matter. Right, let's just go back without looking through all. I think I'm doing 1, 2, and 6. And over the 6 years, running about 2.1% below, and that's an annualized return. And the looking at since inception, about 0.7% below the actual S&P 500. So let's and we want to make that up. And I spoke about the mistakes we've made there. There's the equity curve since inception, and just pull that down so you can have a look. There's one that I wanted to look at in particular, which is if we go back to there, so you can. So I'll put a base 100 on since that's since September. What have we got? It since September 2022, 26th of September 2022. And we are measuring here against a number of benchmarks. One, the red one, that one there is the S&P 500 total return index. The blue one, that's that one there, is actually the portfolio itself. That one there is the NASDAQ 100 total return index. So about the same. In fact, what we do is you can put a value line on here, take it right to the end, and you can get the values. And you can look at these percentages here. So the next one is the composite. That's the magenta one that's down there. And the last one I got on here is Berkshire Hathaway. And we're outperforming that as well. So it's neck and neck between the NASDAQ 100 and the public portfolio over the last 2 years. So just to give some relative benchmark, how are we doing? Keeping score. That's all we're doing is keeping score. We are not letting this affect how we execute. Sure, it might get us to do some research, but while we're doing research, we don't overlap between research and execution. Until we have evidence based on data, we don't change the rules. And when we do, then we don't try and stick and force ourselves to stay with something that we thought was the better way in the past. We let the data determine how we go forward. We are totally objective about it. Right, let's just quickly look at the leverage portfolio. I'll come back to that in a moment. Let's just go to some data. So over the last 12 months, 2023 to November 17 November 23 to current, this leverage portfolio is up 139.7%, and compared to 32.62 in an index. That is just really good growth for an index. So are we in a bull market? Damn right we are. Let's go 2 years, 2022. It's obviously going to be good. Compounded return, 75% compounded return versus 24, compound about 3 times more. Now, this is the ability that that you have with leverage, provided you can handle the drawdowns. So those little 7 and 9% drawdowns we have, or 8% drawdowns we have in the index, when you're trading leverage, it turns into, look here, over the last 2 years, maximum drawdown 9.94% in the S&P 500 total return index, but that turns into a 29%. Look at that on the same day, 27th of October, turns into a 29.47% drawdown trading with leverage. So as you've heard me say many times before, and it's not my quote, it's Larry Williams's one, how well do you want to do? What sort of, how high a return do you want to get? Well, that depends on how deep a drawdown you can handle and still be unflappable in the heat of the moment with money at stake and not flinch and continue to execute as if you'd had 9% drawdown. That's what unflappable is. That's what it means. That's what it's all about. So let's have a look at, we're going back to over 5 years for this one. And you'll see that we have underperformed. Oh, no, sorry, over 5 years we are doing well, but we had a big drawdown in between. So over 5 years, still outperforming the index here, and but a lot more. Look at that, we've had 87% drawdown in that time, and compared to 33% drawdown in the index, and a risk reward ratio, because you're trading with leverage and your drawdown is going to be inflated, if you like, is magnified, is 4.12, which is a much bigger risk reward ratio, and so you get bigger returns, but you get deeper drawdowns. And this is where, if you can trade a leveraged portfolio the way that I'm trading this, then and without flinching and being unflappable and being peaceful about it and being at peace with all outcomes, both individual and equity curve wise, then you know that you have arrived as a trader. And let's just go back to inceptions. As at inception, we are underperforming because of the drawdown. And there's been a whole lot of things change, and to a degree, this has been a research live trading portfolio. That's why I only started with $34,000 and didn't tip the house into it. But we're going to be doing some changes to this portfolio over the coming couple of months. Now, one of the things I want to point out here, without going into too much detail, is this little thing over here called position risk. That is a money management risk parameter, if you like, or a tool or a calculation. And what that does is allows you to increase your position sizes into a rising market when you have momentum on your side, but not so much that because you've got to manage it within this thing called invested percent, which is running at, and you want to keep that at 160%, because you're running this portfolio at 1.6 to 1 leverage. So between those parameters and also margin utilization, you want to stay within certain boundaries. And what that does, allows you to increase your position sizes into a rising market, but not so much so that you continue to get euphoric, if you like. You can see we've still got 2 vacant positions here, and we have available cash and we have margin available, but we're not taking those positions because we're 160% invested at this position risk size. And the same thing happens. So it allows you to rapidly increase your position size in rising markets, but not so much so. How would we take those other positions in there? Well, look at this open trade profit we have at the moment. We're sitting on $27,000 of open trade profit in these portfolios here. So let's just go net profit percent, and we're sitting on some big profits, 80, 88, 87%, 65%, 61%. So when we realize some of these profits, obviously there'll be end of trade drawdown. We'll realize some of those profits. Those profits will go into cash. And when they become cash, it changes all these numbers. And then we will be allowed to we'll be able to fill those positions. It'll drop the percent invested. We'll be able to put that money in again. That money reinvested into get back up to 15 positions, but not so much so that we become too leveraged. And the same thing happens on the downside as well. You start getting money management, risk management exits because your position sizes rapidly decrease. And as your cash decreases, it doesn't allow you to keep being fully invested, even if you're getting entry signals. You have to let them go because you're running into the upper limits of both invested percent and margin utilization and what your next position size should be relative to the cash that you have. So it's a little trick, if you like, that we've been able to develop, and we will talk a bit more about this in coming times. So quickly onto the equity curve, and then I'll go back into the PowerPoint presentation and finish up over to these peaks, recent peaks from the troughs back in September, October of 2022. You can see that this portfolio is up 402% from there, whereas at the same time over the 2 years, the S&P 500 total return is up 73.06%. So about, what's that, nearly 6 times, just under 6 times more growth. They're the drawdowns. They're 29% drawdown. I think we flatlined there for about 6 months, and we've had 200% run-ups as well. So pretty volatile, but that's where we want to get our customers to be able to trade an equity curve like that and get those sorts of returns. Right, I think that is all I wanted. Oh no, there are a couple other things I wanted to show you. If we go into the US portfolio, this is anything can happen. I want to show you Axon Enterprise. Right. Where's the signals? Why are the signals off here? It's path reinvested. Let's turn it on. Okay, I'm going to zoom in on this trade over here, because what happened, in fact, I'll go in a bit more, is the signal was generated here. Oops, sorry about that. The signal was generated on a 18.39% jump in price from there to there. And then on the next day, you can see it rose another 5.5%, the bottom of the tooltip where it says move percent. So this move here was a 26% move, I think, from the close there to where we bought up here. And where do you see that? Well, if we go to here, you'll see Axon bought on the 8th of the 8th at what was the price at 368. So if we go here, oops, wrong one. I'm going to go to there. In fact, we can close that down and we can go into here and we can type in Axon. So there is the 8th of the 8th. There we are at 368.46. Now, most people and there's been some discussion in the education center about people letting trades go because they just can't see. They know what's going to happen. They know what's going to happen because it's already risen 18% on the signal price and another 5%. Well, this is a set and forget. I didn't know it was going to go up 5%. I woke up in the morning and found out that it happened. And this trade is now up. Axon is up 65%. It's 103 days. But and there's had another big jump over here as well. Now, I'm sure the fundamentalists of you will be going, oh, that's because of this and war and that and whatever, aerospace. And they are just innuendo. They're just commentary. They are just noise. What we do is we trade by the market and what it tells us. But let's now go and have a look at a different case at Starbucks. Starbucks also had the same sort of thing. This is an anything can happen, so we'll just zoom in here. Starbucks rose 24% It dipped on the day of entry, so we got it on that day on the 14th of August, and it dropped 2% on that day, but a 24% rise. And it hasn't had the same outcome because, why? Anything can happen, and every moment in the market is unique. And I don't need to know what's going to happen next in order to make money. So that is what's happened with Starbucks. But that's not the only one. There was another. What was the other one? We'll just quickly go through. I'll probably have to go up on this to find the other one. Oh, FTNT, Fortinet. Fortinet also had a 25% rise from that caused the signal on the signal bar, and we entered the next day. On that day, it was down 1.79%, and the 8th of August. And so we had both. We had two. We had Axon and Fortinet happen on the same day. Here we had two 25% rises. We had available capital, had to take the trade. So we don't, because it's gone up, we don't start thinking. It's the wrong thinking to think, I know what's going to happen. It's going to fall. It's going to be a lost trade. Henny penny, the sky's going to fall on my head. Well, what's happened to Fortinet since then is it's broken out to a new high, new all-time high. There's the all-time high there, and then had these other two big, huge bars, a little bit of retracement, which you'd expect. And Fortinet is FTNT, is that one, is up 32% and $5,700 profit. So anything can happen. As I said in these sessions, that's what I want to use these live trades as learning events to drum in the 5 fundamental truths and the 7 principles of consistency, and to live and breathe those. Repeat them to yourselves. We've got 60-odd people doing the Learn to Trade Properly course at the moment with Dave. I think we're 3 months into it, and the comments have been astounding on that. If there's anybody that hasn't yet registered but would like to, we're starting a new Learn to Trade Properly program, set of sessions focusing on the US market, starting, I think it's on the 9th of December. So you would have got an email. If you missed the email or haven't read it yet, there's still time to do that. And it is a really, really good. It's the best training that this business has ever done. I can assure you, it gets you. It really is, where the rubber meets the road, and tackling all these issues head on. And you've heard me say, we've got to create, a conflict in our minds to resolve the dysfunctional habits and beliefs that we have. We've got to create that conflict to be able to resolve them. We can't resolve them theoretically. They can only be done through physical and mental practice, by actually pushing the button when everything in you at that time, all those dysfunctional beliefs are saying to you, no, don't do it. Don't do that Axon trade. You have to do it and go through the process. And you have to do it with real money at stake, under the pressure of all those negative thoughts, those dysfunctional beliefs coming to the fore to stop you, to try and stop you to do it. And then do that multiple times, live through those experiences to reprogram your belief system with respect to trading, and then build new habits, as James Clear tells us, and how we do that, through experiential, training, through living through the events. So that's kicking off I think it's the 9th of December. So there's still time to start that, do the prep and everything that Dave's running. Just send us an email and Dave will send you the prep information that you need to do, to get into to do that. Right. To finish up now, I want you to just talk about the rules change and why we've done it, in case you missed it last time. And also just to remind you, if you did see it, just so it becomes a bit more important. So just quickly, what we did is from June to November 2022, we did a parameter re-research, because we were in this drawdown that felt like it was getting to be a bit bigger than what research had showed us. At the time, we hadn't quite maxed out on the maximum drawdown. I think the ASX maxed out in the portfolio at about 23%. So we went from about 15 max drawdown prior to that, in the 6 years prior to that, to 23%. In the US, I think went to 33% drawdown. And I think we were running at about 18 or 19 at the time. Also bigger than what we like. So we started doing some re-research of the parameters and came through with a few things. We also created a stock filter, and we turned that on the ASX in November 2022. And then in May 23, the research that we had done from June to November, after doing the dev and all the sort of stuff we needed to do, we went live with those in May 2023 on all the public portfolios. With ASX, obviously the stock filter stayed on, but in the US, it was off. In October 24, just last month, we did some re-research over a period of 2 or 3 weeks, 3 or 4 weeks, with using out of sample data from May 2023 to then current, with and without the stock filter. And the research showed us that clearly that we should turn the stock filter off. So as of the 30th of October, so since the last time we met and did one of these, we have turned the stock filter off. And what we have and what was that research based on? It was based on this, okay, running some simulated portfolios against the just simulation, and also the stock filter on this green one here. It looks very similar to the public portfolio. It's the sideways moving market. And so if we had at that stage in May put the stock filter on, that is May, yes, this is, off, turned it off rather than having it on, this is the effect we would have had. Now, as it turns out in our research, having the stock, and this is where trading gets difficult and we have to be objective about it, is having the stock filter on during bear markets is a good thing. Having it on during rising markets is a bad thing. And that's what has been a handbrake on the ASX public portfolio, at least over the last 18 months, when we've had a bit of a rise out of the trough of the sideways moving range. And that is doing it from if we had done it from inception, you can see whether it's on or off during this period for the first 7 years of the portfolio. You can see even here when we did have in 2022 a falling market, we had more drawdown there. Here we had sideways, so the stock filter being on during 2022 would have been a good thing, but we haven't got this rise out. So overall, over a large sample, stock filter on in the ASX is more of a handbrake than having it off, but it does reduce drawdown in sideways in falling markets. That's the red line is where we actually made the change. That's in May 2023. Right, so just to finish up, we have to look at where we are in the market at the moment. These dotted lines here, I think it's 204,227 days since the breakout over there. That's including weekends. That's 11 odd years. That is where we are in the current market as of yesterday's close. If we take the same number of days from the break, and I cover this material in some detail, you can go and have a look on the YouTube channel, and you can see the last secular bull market update I did. I do this in quite a bit more detail, but the same period of time from that breakout in 1982 to where we were in that bull market, that secular bull market, then takes you to about there. So there was still that to come, which was quite extensive. And in the breakout from in 1949, the similar period takes you to about there with that run up still to come. So it just gives us a rough idea of where we are in the secular bull market. And sure, there's some more to come, but maybe not. We're not predicting. We're just going to let the market tell us, like we did, like at the beginning of the session where I said, all these big name commentators who have made trillions in the past are all calling this market sideways, have all been proven wrong by this breakout to the upside we've had on the S&P 500. Well, that doesn't mean that this is definitely going to continue going up. So it's not a prediction, it's just giving us some big picture perspective. But going into the period we're going into, we are relative to the last secular bear market that went from 2000 to 2013. We are somewhere over here. And in that last 4 or 5 years, if the secular bull market goes that long to be similar to the previous one, the market could go up another 100%, but not in a straight line. But we don't know that. This may be the end, and that's okay. Because why? Because we've got exit signals in place. We're not buying and holding ETFs right through for this portion of money that we're doing. You can still do that with another portion of money, but if you're active, you want to have a mechanism which gets you out and takes you into cash for these periods of time. So I'm going to keep reminding you of that in these sessions. I won't do it every session, but every now and then I will. because that's what we have in the back of our mind, is protecting against this while giving us the opportunity to get this rise. Okay, that's it for today. Are there any questions? There is something here. I've got a red dot. Bruce, great session today. Pleasure. Don, did the new review of the effect of the stock filter really show any different results to that done originally, or has there been a different acceptance of the potential for higher drawdown? Don, great question. So there was a call to be made back in April, May of 2023. And that call, because when you looked at the results just told me exactly what I've said now, is that in falling markets, having the stock filter on is far better than having it off. But in rising markets, it's far better to have it, to have it off. And at the time, I made the decision, take full responsibility for it, because I went into my own money portfolios as well, is that we erred to protect against the downside rather than be greedy to the upside. And I felt at the time, looking at the research, because we had done a whole bunch of equity curves, which some started in 1992, but most of them started in the year 2000, is that there was still going to be sufficient upside regardless of, and we'd have the downside protection. As it turned out, the sample of data that we've now researched since showed that it put a bigger handbrake on the upside than what the research showed, which is probably a tick in the box and a vote in confidence for the research that had been done, because that research of recent times was showing that it would be better. I just looked at a longer, bigger picture to make that decision. And as it turned out, it was, hairy hindsight, it could have been better. And so rather than continue with that, because that is the decision that was made then, rather than be stubborn about it, I'm being objective about it and saying, hey, why go against the data? The data showing that the stock filter should be off. And so that's what we've done. Now, if we fall into raging bear market, we're still going to get entry signals that come up that otherwise wouldn't come up with the stock filter on. So we'll have to deal with that when it happens. But at the moment, we're in a raging bull market, and we've got to act accordingly. Okay, Dennis, pleasure. James, compliments on LTTP, very well. Very great to review data. Okay, good. Thanks, James. John, pleasure, John. Right, we'll finish there. Gone a little bit longer. Thought I'd look at a bit more individual stocks today, live in Beyond Charts. Thank you for your time and attendance. And as always, I wish you objective, consistent, and peaceful, active investing.